Good morning, you magnificent melon heads. I am nobody special, and welcome to Morning Update Live. Stocks are down this morning after we got some mixed earnings, to say the least. Some were up, some were down, but we got a lot of the consumer staples this morning. We got 3M, we got GE, we got Johnson and Johnson, we got a lot of defense stocks. So a pretty good snapshot of the economy as a whole coming in this morning. And well, it was kind of a mixed bag. Some were up, some were down. Some of the forecasts were looking a little rosy. Either way, it seems like the market didn't like most of that news. Namely, it was 3M because 3M, well, they make everything, right? Everything from Post-its to notepads to respirators to medical supplies. 3M, they got their fingers in a lot of pies. And they announced some really weak consumer demand and that they're laying off another 2,500 people. There's that word again, layoffs. We've been talking about that an awful lot, how layoffs is the missing ingredient to a housing crisis. And it seems like every day there's another anecdote about another few thousand layoffs. So that's another one that hit the tape today. And it seems like that's the one that's really driving the market sentiment. So with that, let's shrink my big melon of a head and let's see what's going on after the opening bell. We've got the S&P is down about a 0.5% or 0.55% at the moment. We've got the Dow is down 184 points or 0.55% after a heck of a day the Dow had yesterday. And we've got the NASDAQ is down 68 points or 0.6%. So stocks down across the board right now. We've got the U.S. dollar is pretty much flat. The Dixie is at 102.2, 102.19. So the Dixie's not really a factor today. Looking over in the bond space, it looks like the yields are mixed this morning. We've got the short end of the curve is just a little bit higher, 3 basis points, 1 basis point. And then at the long end, we're down a couple of bips. Pretty much things not moving in the bond market, although a slightly elevated inversion of the yield curve, which makes sense as stocks are worried about recession this morning. Looking over at commodities, we've got pretty much flat to negative. Gold is up about $3 right now, or 19.31. Gold fared pretty well yesterday, considering that sell-off we had in silver that was absolutely brutal. Silver was down over $1 at one point yesterday morning. It was reminiscent of those 2021 price smashes that we got during the silver squeeze. Gained back some of that. It's down a little bit, about 6 cents right now at 23.49. So we'll keep an eye on silver. Crude oil is flat at 81.63. Now, crude is one of those ones that is right now is caught between these two narratives. You've got the narrative of the end of the dumping of the Strategic Petroleum Reserve. You've got the narrative of the China reopening and an expected surge in demand for oil in China. But at the same time, we've got this narrative of a deep, severe recession in the West, and that would result in a lot of oil demand destruction. So which of these narratives is going to win out? Well, so far, it looks like the narrative of the China reopening and the end of the SPR sales is really what's driving things right now. Because if we look at this oil chart, it looks like we are on the verge of completing this little inverse head and shoulders pattern that I drew a couple of days ago on my Patreon Zoom call, not live stream, excuse me. Shout out to my Patreon supporters. Thank you guys for everything you do for the channel. But we're right here around this neckline, pushing a breakout right now. Now, we've had some really lousy inventory data here in the States for 2 weeks in a row now. We've had big inventory builds in crude. So we'll see if that holds up. We get that data later on this afternoon. 3 consecutive weeks of big inventory builds in the U.S. should be enough to send prices lower if we get another number like that today. We'll see what happens later on. Also in the commodity space, something I've been watching has been natural gas. And right now, natural gas. Now, this number, this is the Henry Hub futures are showing on TradingView. And I got to remind you guys, I'm a little new to TradingView, and this is showing different prices than what investing.com is. I'm not sure of the difference in the prices, but the trend is accurate. So I'm showing this for trending purposes. And right now, natural gas, if we zoom in, it's just threatening to retake that 9-day moving average, which is something I'm looking for to signal a bottom. We've had a slight uptick in the RSI. It looks like this one is trying to bottom out right now, but still heading lower. Now, the reason I mention this is because the last time the RSI was anywhere down at these levels, like we can see here from October of 22 and July of 22, we got very sharp recoveries in price. And I'm hoping we get a duplication of that result this time around. So as soon as I see a full candle close above that 9-day moving average, I will probably be initiating a position in natural gas. But right now, no position in that at all. All right, let's talk about 3M right now because that's the big story this morning. 3M to cut 2,500 jobs as demand weakens and profit drops. 3M said on Tuesday it would cut 2,500 manufacturing jobs after reporting lower profit as the U.S. industrial conglomerate faces a demand slowdown in its unit that sells products including notebooks, air purifiers, and respirators. Again, 3M folks, they have got their fingers in a lot of pies. They do a lot of, they make everything at that company pretty much. So them cutting jobs, that is a pretty good barometer for the overall health of the consumer in the United States. And 3M stock right now, not really liking it. Give this a moment to refresh. It was down about $5 pre-market, currently down 672 or 5.5%. And a good way to look at where this is coming from is this chart here. We've seen this a lot on my channel. This is consumer credit cards and other revolving plans. This is basically America's credit card bill, currently sitting at an all-time high of $941 billion, inching closer and closer to that 1 trillion mark. Americans have put the cost of inflation on the credit card, and they are further and further into debt. And with rising rates, well, that is a very big problem. Something Fox Business was sniffing out this morning with this article. I'm sorry, this was dated yesterday. Consumers are piling on credit card debt, flashing signs of a potential crisis. And again, this all leads into why 3M is laying people off and why 3M is seeing this decline in earnings. Signs of a looming consumer debt crisis are flashing. And there's a lot of anecdotes in this article that mentions things like Discover Financial issued an ominous warning last week, noting that in the credit card portfolio, the net charge-off rate of 2.37% was 87 basis points higher than the prior year and 45 points higher sequentially. So we've had Discoverers warning that people aren't paying their credit cards. Meanwhile, credit card balances have been climbing after months of elevated inflation outpaced wage gains. Discover anticipates the default rate will grow even higher in 2023. The Federal Reserve Bank of New York reported a 15% year-over-year increase in total credit card balances for the third quarter. Got a new report from creditcards.com released on Monday showing 3 out of 4 credit card debtors added to their balance over the last year. Nearly half, or 48%, took on additional debt due to rising costs. So story after story piling up here about Americans going further and further into debt. We're seeing the results now in 3M's results. And here we go. This one came in. Shout out to my moderator, Mish, who dropped this one in the comments right before we started. The Red Book Same-Store Sales Index. This is a year-over-year snapshot taken on a weekly basis of same-store sales in the U.S., and it increased only by 4.6% for the week ending January 21st, well below even the government-stated rate of inflation. And you can see here several consecutive weeks of decline in same-store sales here in the U.S. It's all painting a picture that the American consumer is cash-strapped. And the American consumer is the economy, folks. We are pretty much a 70% consumer-driven economy here in the United States. And you'd never guess if you looked at some of the government numbers. The Atlanta Fed's GDP Now number just came out 3 days ago. It's forecasting 3.5% economic growth. Somebody explain the math of this to me. I don't get it, but there it is right there in print. Then this is the final nowcast. We get the GDP number for the fourth quarter on January 27th. That's this Friday. And they're saying 3.5% economic growth in the United States. Again, the math on this one escapes me, folks. I just don't see it. I don't know where that growth is coming from. Certainly not from consumer spending. Maybe it's all debt. And I want to send a shout out to Mike Binders from Robinashi Models. Thank you, sir, for the super chat and the support of the channel. Mike says, good morning, Jack. EU gas storages are full. Doom postponed. Yes, sir, they are. Congratulations to EU energy policy makers. You rolled the dice on a warm winter, and the dice went your way. And thousands of people didn't freeze to death. So you must be very proud of yourselves for your garbage energy policy where as long as it doesn't get cold, you survive winter. So far, that has worked. That's going to work right up until it doesn't. And the cold still has not arrived in Europe, and so Europe's gas storage is still full, and their power prices have not skyrocketed, and their economy hasn't collapsed, as a lot of people, including myself, predicted they would this winter. So Mother Nature had something else to say about that. Thanks again, Mike, for the super chat and for the support of the channel. Guys, I want you to have an awesome, awesome day. Thanks, Mom and Dad. I love you guys. And until next time, live small and dream big.